Learn these 8 strategies to help reduce your taxes on your railroad retirement. Welcome everyone to another edition of the HIghball Advisors Railroad Retirement Whiteboard. My name is John McNamara of HIghball Advisors, and we're going to talk about reducing taxes on your railroad retirement, right? You're collecting your railroad retirement annuity, you got to pay taxes on it. So let's look at some things that we can help, keep an eye on it, see if we can get those taxes reduced. And even if you're not collecting your railroad retirement, some of these strategies are things you want to start planning about before you even start your annuity. So pay attention, we'll go through them and let's see how it goes. So first of all, let's remember how the taxes are paid out. So on the Tier 1 portion, so a married, this is 2024, so married filing jointly, anything over $44,000 of income, 85% of your Tier 1 portion is taxable income, right? Not at an 85% rate, but 85% of it is taxable. The Tier 2 portion is taxed as ordinary income. And just as a little sidebar here, the Tier 1 portion can also be taxed at ordinary income if it's that portion between 60 and 62. So if you're a retiree who's got your 30 years, that's called the non-Social Security equivalent benefit. That gets taxed at an ordinary income. So, so that's there. So all right, so let's look at some strategies here. Now, over time, you're working, you're accumulating quite a few assets, hopefully. There's ways to withdraw that money out of accounts. So you have taxable accounts. So that would just be like a brokerage account. You pay capital gains on that. You would have a tax-deferred account, maybe like an IRA, 401k, and then your tax-free account. So the way you want to draw those funds down, the most tax-efficient way is the taxable, then tax-deferred, tax-free, right? Tax-free, just want that thing to keep growing, 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 never to pay taxes on it, all right? So that's the way, if you need money, that's the way you should be drawing down on it, all right? The next 3 I group all together because it all relates back to the tax deferred part, right? So when your money gets deferred in taxes, right, you're making money now, but at the end of the day, the government wants their money. So when you do have to pay that, you want to pay that out basically on your own terms, as I like to say. So you got to reduce the RMDs, required minimum distributions. That's when the government comes and takes their money. Probably be at 75 for some individuals, might be 73, but then you have to start paying those. So you want those to be reduced because if you have quite a few assets, that could bump you up into a higher bracket because you're going to pay those at ordinary income tax rates. So the Roth contributions, that helps also, right? Puts more money into the tax-free, so you're paying the tax a little bit up front. And then Roth conversions, I think this is a really big one, especially for those railroaders that retire early. Really great opportunity to give you a long runway to slowly pay down those tax-deferred accounts, move them into tax-free. So when RMDs come around, really a non-event for a lot of railroaders. If you've been doing strategic Roth conversions throughout the years, it won't be that big of a thing. Next one is other ways to help kind of reduce the taxes is qualified charitable distributions, right? So for those who are charitable inclined, you might have an RMD. What you can do is just take that money and put it to charity, and then there will be no tax on it. So that's a great one. And then this kind of, once again, groups together is make those charitable deductions. That is, if you're going to be itemizing your taxes, just contribute straight to a charity is a great way to do that. You can also do it through a donor advised funds, but I think I did a video on that. I'll see if I can put a link into that. And then another strategy is tax loss harvesting, right? Some of those taxable accounts might have some not underperforming investments, let's say, certain stocks maybe didn't perform as well, and you might have a loss in that. So you want to sell those, okay, take the loss, right? That helps bring down your taxes, knocks your capital gains down, and if you have more losses, you can actually take the $3,000 off and then carry forward those losses into the following year. All right. And then another one is when the latest round of, I guess what they call the Trump tax cuts, they put a limit on the amount of taxes that you can do for up to $10,000 on the, so what you want to do is just put as much expenses as possible, right? So everybody has their same amount that they get, that standard deduction. This year for a married filing joint couple, I think it's going to be close to $30,000. But if you do charity and medical and even the property taxes, if that gets up over $30,000, then you want to look to itemize. So that's something you want to look at if you can bump up a couple things into the same year. So maybe your medical expenses, right? If it's, unfortunately, if you have big medical expenses, you want to bring those all into 1 year to help get that itemized deduction and charity, as I mentioned. So those are some of the strategies that you want to look for to just kind of help reduce the taxes in railroad retirement. And just as a bonus I like to throw in here is just remember when you're doing your taxes also, there's no state income tax on your railroad retirement. So a lot of tax preparers will take their, they'll see on the federal that you have, on, I think it's line 5B, taxable pension annuities, and a lot of tax preparers will just drop that right down to the state line, and you'll wind up paying taxes on your Tier 2 portion or your non-Social Security equivalent benefit portion. Just make a note of that. And then the other one is also to reclaim your Tier 2 contributions in retirement. I'll do a video on that later, but remember, those Tier 2 is not a tax, it's a pension contribution, and those can be reclaimed throughout your railroad retirement years. So anyway, this is a little roadmap to help you out with the taxes coming forward this year and years going forward. So until the tax laws change, we'll stick to this strategy for now. All right, so reach out to me if you're at or near retirement and interested in understanding your taxes, especially in retirement. Two biggest expenses, taxes and healthcare. So you got to understand your taxes when you come into retirement. You want to give it all away, as they say. So sign up for my boarding for railroad retirement process. We'll go through that. Click on the notification bell to get the latest video. And until next time, everyone, please stay safe, stay on track, and take care. So long, everybody. Bye.